The housing market is starting to show some signs of weakening. I'm gonna pick 5 ETFs that will allow me to capitalize off the potential downside of the housing market. You gotta be ready for whatever, whenever. And these are the tools that I'm gonna utilize in the future, near future, 6 to 9 months. Without further delay, these are the 5 ETFs that I will use to capitalize on the opportunity when it presents itself. The first one is going to be SRS, ticker symbol SRS. This is the aggressive play. If you see major home builders like Lennar or D.R. Horton, if they miss earnings, this is where the potential volatility is gonna go. And you'll see it move significantly if said companies don't make their earnings. Next symbol is gonna be REK. This is gonna be a direct play against the Dow Jones. Straight play. The Dow starts to fall, this is gonna go up. Now the next ticker symbol is DRV. Now this one is high, and I do emphasize highly volatile. If the NQ and ES, if they're dragging the whole macro environment down, you can see significant movement, significant swings in DRV. The next ticker we're gonna look at is gonna be TBT, ticker symbol TBT. This is the 2X version of the rate play. If the 10-year breaks its local resistance, then the TBT is gonna be your direct short to the housing sector's affordability. If rates stay higher for longer, the wait and see policy, ticker symbol TBF, is going to be the way to go. If you expect rates to stay high for longer, TBF is going to be the way to go. Right now, the biggest portion of opportunity is coming from the subprime crisis or a bank collapse, possibly. It's driven by one thing, and that's the gap. What people earn and what these houses cost. There's no soft landing. There's no good median between the two. Houses cost too much and people make too little. And until that gap closes, the pressure to the downside is gonna be relentless. In confluence with all of that, the cost of goods due to political circumstances or just inflationary circumstances, the cost of manufacturing, everything has skyrocketed significantly. Historically, home prices used to be 4.5 times the median household income. Since 2026, rough data is showing that this has increased to at least 7.5%. Those people that used to have the 3% mortgages that were holding on to them things like gold bar, that's changing too. For whatever it may be, family, job, health, whatever it is, they're having to move. And when they move, they're stepping into a higher percent. If they do even purchase another home, they're stepping into a much higher percentage rate than what they're used to. That's gonna cause economic strain on so many families. The gap between the income and housing prices has to close, bottom line. Now, it's either they're gonna start paying people more or they're gonna bring the housing prices down. I don't know about you, I don't see them paying us more. The prices, they have to come down. But just to reiterate, my 2 cents, I'll look at REK for long duration moves. and then I would go to DRV for intraday shifts. Those would be my biggest ones. If I had to just pick two, those are going to be the two that I will definitely give the most attention to in the coming days, weeks, months. Like I said, this is only for the next 6 months to 9 months, but whatever is going on in the geopolitical space, wars and everything included, can expedite significant changes in any of these tickers at any time. So always remember to trade responsibly, keep your wits about you, always do your research, don't risk more than you can lose. And remember, retain in your brain, sustain to maintain. That is it.